everyone, welcome back to our channel where we break down complex financial concepts into simple, relatable terms. Today we're diving into the world of banking to talk about something that can make or break a bank, non-performing assets or NPAs. So what are they? Why are they such a big deal and how do they affect you and me as customers? Stick around and let's unravel the story. Let's start with the basics. An NPA or non-performing asset is essentially a loan or advance given by a bank that has stopped generating income. Think of it this way. When you borrow money from a bank, you're expected to pay it back with interest, right? But what happens if you stop making those payments for an extended period, say 90 days or more? That loan becomes an NPA. In simpler terms, it's like lending your friend money and realizing they've stopped paying you back. For a bank, this isn't just a minor inconvenience, it's a huge problem. Now, NPAs aren't all the same. They're classified into three categories based on how bad the situation is. First, we have substandard assets. These are loans that have been non-performing for less than 12 months. There's still hope of recovery here. Next, we have doubtful assets. These loans have been non-performing for more than 12 months. Recovery is uncertain, but there's still a slim chance with effort. Finally, the worst case scenario is loss of assets. Here the loss is confirmed and the bank knows it's not getting that money back. So, why do NPAs cause so much stress for banks? Let's break it down. First, they hit profitability. Banks earn money by charging interest on loans. When a loan turns into an NPA, that interest income stops and profits take a nosedive. Next, NPAs erode capital. Banks are required to maintain a certain capital adequacy ratio to stay in business. If they have too many NPAs, they have to set aside more money as provisions, reducing the funds they can use for lending or investments. And here's the scariest part. A high level of NPAs can threaten a bank's survival. If a bank cannot recover its money and runs out of funds, it could face insolvency or, in extreme cases, even shutdown. Plus, let's not forget the ripple effects. High NPAs mean less money to lend, making it harder for good borrowers to get loans. Investors lose confidence, stock prices drop, and the bank might find it harder to raise money. It's a vicious cycle. But don't worry. Banks aren't sitting idle when faced with NPAs. They have several strategies to tackle this problem. First, they might restructure loans, offering borrowers more time or lower interest rates to repay. If that does not work, they'll try recovery mechanisms. This could mean taking legal action using recovery agents or auctioning off assets like property or machinery to recover some money. In cases where recovery seems impossible, banks may write off the loan. This means they remove it from their books, although it still impacts their finances. Lastly, banks are required to set aside provisions for NPAs, which act as a buffer for potential losses. So what's the takeaway here? NPAs aren't just a problem for banks, they affect everyone. When banks struggle with NPAs, it impacts their ability to lend, the economy slows down, and trust in the financial system takes a hit. That is why it is crucial for banks to manage NPAs effectively and for regulators to keep a close watch on this system. And that wraps up today's topic on NPAs. I hope this helped you understand why they are such a huge deal and how they impact our economy. If you found this video useful, do not forget to hit the like button, subscribe for more such content, and share it with someone who loves learning about finance. Thank you so much for watching, and until next time, stay curious and stay informed. See you in the next one.